On opposite sides of this issue, Jim, you do not think that this is a bear market, and we've just seen a bear market rally. You're more positive. Why?
Yeah, I think we had our correction, which you normally get in the second year of a bull market. It probably lasted about a year, starting last March. I think most stocks haven't done much since. And it did what corrections do, Sarah. It took the concentration of leadership out of new era stocks. It significantly revalued most of the market, and it scared us all to death. And the sentiment indicators are still very pessimistic. And we've done all of that while leaving the fundamentals in the economy really strong, created 525,000 jobs a month in the first quarter. So if I like the combination of a lot of fear, a lot of things to worry about, and good underlying fundamentals, I think that's a dynamite combination for the second leg of the bull.
Peter, why do you disagree?
Well, you know, the economy always feels strong like this at inflection points. And, you know, there are sort of three ingredients that typically present themselves prior to the inception of a bear market or even recession. One is a Fed tightening. Two is some sort of a price shock or commodity shock like we're seeing in oil. And then thirdly, some sort of a global systemic shock. And frankly, I think this is a rare situation where we almost have all three at the same time. And so nominal growth may look strong, but that's precisely what it is. It's nominal. Inflation sort of changes the way we need to analyze that data.
So then how do you perceive, Peter, what we've seen? I mean, the last week, yes, we're headed for a loss in the S&P of 1%, but pretty tremendous resilience in the U.S. stock market to some of those threats that you just outlined.
Yeah, not at all unusual to see pretty convex rallies within bear markets. In fact, they can be some of the most tricky rallies to navigate if, in fact, one is looking to hedge risk or reposition a portfolio. But I think that's precisely what we have here. It's not surprising to me. When I look across at other asset classes, when I look, for example, at speculative grade spreads, they're almost 400 basis points. And I think they are telling us something that perhaps broader equity indices are not.
Jim, there's also a troubling fact, which is the leadership in this market has been very defensive. Healthcare, staples, utilities, suggesting that economic weakness is coming. So how do you interpret some of those risks that Peter was talking about, the price shock, the inflation shock, what we're going to see with central banks, and the fact that the market is not exactly sending a bullish signal on the economy?
Well, I think that bear markets don't generally start on day one of Fed tightening. It generally takes several in time before that occurs. And I agree that, to his point, there's a lot of things people are worried about. The problem is, I think we've been vetting most of these for quite some time. Most of the last year, we certainly have been vetting the Fed ever since August. And I think the market's kind of adjusted to that already. A lot of the fixed income market's already adjusted to that already. Look, tightening happens in every recovery. It's part of the success of a recovery where tightening has to be done. That doesn't mean the recovery's over by any stretch of the imagination. And this isn't just nominal growth we got going on here. As I said, we created 525,000 jobs a month in the first month of payroll. We created 862,000 jobs a month household. That is not the stuff of lack of real growth. That's very strong real growth. Capital good orders going up, profits keep going up, estimates of earnings keep going up. These are all signs of a really healthy economy. And the balance sheets, Peter's point about getting in trouble, I've never seen a household balance sheet this healthy, maybe in my entire career, in terms of liquid and low debt to equity ratios, low debt service ratios. Corporate sector is just about as good because no one's been borrowing a lot of money. I don't know. I think that there's really good odds inflation rolls over, Sarah, in the second half of this year, mainly because we got supply coming back with the labor force now surging in recent months that we were missing. And if that happens, a lot of these fears about the Fed and about how high rates have got to go up are going to dissipate and optimism return.